Welcome to FinTech Insider. We've now been downloaded in 140 countries and are top of the charts in iTunes in the business category again. So thanks for listening. But we do really appreciate those reviews on iTunes and any platform you can, so bring those reviews, we love them. I'm Simon Taylor, and I'm joined by some 11FS colleagues. Chris Skinner. Chris, say hello.
Hello.
And Aidan Davies, who you heard way back on our 4th ever episode. Aidan, say hello.
Hello, Simon.
And of course, we brought back the best guest host ever for any show in the world, and I don't believe in hyperbole. This is Gela Boshkovich, the founder of Femtech Global. Gela, how are you?
Simon, you do hyperbole so beautifully. Thank you.
It's what we're all about. It's not FinTech Insider, it's FinTech Hyperbole. That's what this week's theme is. David Breyer and Jason Bates are sipping coffee in Vienna, according to my show notes. I think they're doing something deep and dark and possibly dangerous. I don't know what those two get up to all by themselves. But anyway.
It means nothing to me.
Oh, somebody had to make that joke, didn't they? Today we're talking all about APIs, and we've got some great guests joining us. So we have Leslie Ann Vaughan, the creator of M-Pesa and the director of Mila Consulting. Leslie.
Hello.
Good to have you with us. And we have David, I'm not going to try and say your last name, the VP of Vertical Solutions at Apigee. David, hello, and please say your last name.
It's Andrzejek, and hello from sunny California.
David, thank you so much for being with us here today. Okay, so let's get on with the news. Alrighty, so the first story up is from Finextra. This is the US regulator citing fintech as a risk to the banking system. Look at us being so risky. And there's a full report. So Gela, I don't know if you've had a chance to look at this one or you had any thoughts on this subject. Are you a walking, talking risk to the banking system?
I personally always have been a high risk to any system. But in terms of that lengthy report, it's only 30 pages with a few graphs and charts. So if somebody did want to breeze through it and over lunch hour, not a problem. But what was interesting is the highlights from the report are really about the business model changes and growing revenue for the banking system. Some of the risk assessment was around how do banks adopt innovative products and services and processes in response to what the end customer is really demanding now in their financial services experience. But it was also about the risk of competition. And that comes in with having fintech as an alternative provider of services. When we look at your wire transfers or your money wallet or your investment advice, all of those different things apparently come with a risk association. The OCC, the Office of the Comptroller of the Currency, is actually quite interested in making sure that seamless integration of fintech into the US banking system happens, but the risk does come with it. And they've also kind of looked at the underwriting practices to increase loan volume. And that is one of the things that fintech does, especially the alternative lending platforms. So how do you minimize and mitigate risk when you've got an alternative business model? And that's part of where fintech is really, I hate the word disrupting, but where they're challenging the traditional models. So operational risk, that's always a challenge, and especially with cybersecurity. And Chris, you and I were chatting just before Christmas about top trends. And even though I mentioned cybersecurity is not the sexiest trend for 2017, it actually is critically important, especially with the OCC's report. So cybersecurity still remains a really rich topic that has to be explored and actually looking for really rich solutions, but that lends to the risk appetite or lack of risk appetite for the OCC.
It's also worth underscoring, I guess, that the OCC is encouraging fintech startups, and that at the moment they've got a lot of fragmented regulation in the states at federal and state levels, which means it's too difficult to launch a new digital bank. There isn't a new digital bank in America, full stop. There isn't one. But the OCC at the end of last year offered a fintech banking charter to startups to enable new fintech companies and also existing ones like Stripe, for example, to move into full bank services nationwide. So rather than being a threat, they see this as an opportunity to change the banking system, I think. So there's a mixture of different activities going on there.
There also seems to be a bit of a fight going on. So I think Banking Technology reported that there was 2 Democratic senators who've spoken out against the OCC creating this charter.
Durbin actually was one of them, which is an interesting mix, right? I mean, when you think of the Durbin Amendment, he actually voiced his concerns about it. But there is, because of the fragmented nature in the US and because of the lack of regulatory involvement at a community/industry level like this, it's definitely new territory for them to explore. And the whole point is to challenge the traditional model. But how do you do that in a way that allows for that risk to be mitigated? And I think we're going to be hearing a lot more from the OCC, and in association with that, the various local government and federal government discussions around how to crack open the industry and allow for technology to really replace an antiquated business model. Yeah.
This is David. I find this kind of interesting in some ways, because it's kind of like your crusty uncle or your frumpy auntie telling you that you need to up your style game or you won't get any dates. I mean, to a certain extent, the regulator is coming in and telling these banks, hey, look, you guys better get with the program because this is, there's some strategic business risk for you in digital, which would probably be the last place I would expect to get warning and advice would be from a regulator. When you actually read the report, though, anybody who kind of even tangentially follows this space, will realize that there's not a lot of detail, right? They basically just point in the general direction of digital and fintech and say, hey, look, there's some risk there. But as a bank executive, that would have to give me pause to say, what am I missing? Hear all this noise, and now even the regulators are telling us, hey, there's danger over in this corner. You'd really have to start thinking about it twice as hard.
I think what's also interesting here, David, is that with Donald Trump, president-elect, coming into office just in a few weeks, he surrounded himself with Goldman Sachs bankers and billionaires and millionaires, and a fundamental disruption to the banking system that the OCC encourages through technology, I don't really see happening under a Trump administration.
I actually disagree. I actually think it would almost be encouraged in some ways. I mean, I realize he's got a bunch of bankers that's surrounding him, but the theme has very much been pro business, less regulation, open things up. With the exception of some of his comments on trade. So I would not be surprised if they said, hey, yeah, go fight it out.
What do you think of Keith Dodd-Frank? Because he said that he's going to rip it up.
Yeah.
So if it's deregulation, though, and deregulation is the theme, then it could also be deregulation of lobbying, and the banks have been pretty effective at lobbying in the US. Indeed, that's part of the reason why creating a new bank is so incredibly hard in the US, is because of the high barrier, not just set through some of the lobbying, but then also the fact that regulation is state by state and varies so incredibly wildly. But it is something that seems to be happening consistently from a lot of regulators. It's this weird schizophrenic world we find ourselves in where, as you say, David, regulators are pushing banks to get better at digital, and it feels like banks like to dress themselves up in being amazing at digital. But actually, when you scratch a little bit beneath the app, a little bit beneath, we have an app, underneath that there are these systems that have been there for 20, 30 years and need like wholesale rethinks, or need at least some modern APIs or some modern middleware to try and make sense of what's going on underneath there. And this is a great subject, and we could probably talk on and on about it, but we've got 6 other more stories to get to, or at least 5 more stories. So I'm going to move on to the next one, and whilst I've grabbed the mic, I might as well own it a little bit. So here's one that comes from IB Times, and it talks a little bit about the DTCC creating a credit derivatives blockchain with Axoni, IBM, and R3, which is just a lot of vowels and a lot of letters. But let's just try and unpack that headline a little bit. The Depository Trade Clearing Corporation, which clears something like $1.6 quadrillion per annum, which is many times the world's GDP, which is just a phenomenal number. But then consider that these are 30-year contracts, so actually it's not moving the money, it's moving the potential money. Anyway, is creating a credit derivatives blockchain. So credit derivatives, special type of contract moved around in financial markets, working with a startup called Axoni, a company you might have heard of called IBM, and the consortium of over 70 banks, R3. Now, what's interesting to me about this is it proves a macro trend that I've been talking about for about 3 or 4 years now, which was 2017 will be the year this stuff becomes real. And what the DTC are talking about is really upgrading their trade information warehouse. So the trade information warehouse is this centralized entity that provides a registry of all trades that happen, pretty much most of the trades in the United States. And this was really crucial in the global financial crisis because regulators were asking, what is the exposure between banks? Is the world going to implode? Do banks have 200 billion, 200 trillion? What's the exposure between banks? Oh, no, we don't know. And the DTCC said, no, it's not 200 billion, it's 6. And the regulator went, no, it must be more, it must be more. And the DTCC went, no, it's 6. That's what the exposure is. And if you go back and look at the reports, it was actually 6. So this is a remarkably important piece. It's almost at the very heart of financial markets. But there's a problem. It's highly expensive. This centralized entity is very, very expensive to run. So the CEO of Axoni talks about that golden record is kind of something that this one organization owns and nobody else can see. So being able to synchronize against that golden record and have exactly the same data as that golden record is hugely beneficial to financial markets. What I often compare this to is if you imagine there are a couple of hundred banks in the world, they're actually talking to each other in Chinese whispers. In other words, one bank sends a message and another bank receives the message. And by the time you get to the fifth bank, they don't know what was actually said at the first bank. It changes subtly as the message moves throughout the financial system. And there's this one central place where you have the message, but actually it's really, really expensive. So what if we had a system that could keep all of those messages and all of those records for trades all in sync? Wouldn't that be something that was really important and really required? And that's exactly what they're trying to build here. The observation I want to give before I throw this open to the call is that what's really interesting to me is you've got a startup, you've got a big major vendor and a consortium of banks all kind of playing nice on this to me. And it feels like a weird stage play, like some weird kind of awkward romance going on. Like there's three in a bed sort of thing. It's a little bit odd. But let's see what happens with this one, because I think the DTCC are taking a real lead here and credit to them. Any thoughts from anybody around the call?
Can you just clarify something, Simon, about Axoni and the Hyperledger, and that this is all based on Hyperledger, isn't it?
No, it's actually based on AxeCore. So AxeCore is code that has been developed by Axoni themselves. So this is proprietary code that the startup has built, and IBM are providing project management and expertise and integration into the banks, and generally their knowledge of how all of the existing systems work in the DTCC. So IBM are doing a lot of the heavy lifting, but some of the core components are actually built by Axoni. Now, I don't know for certain if some Hyperledger pieces will be included.
Axoni's AxeCore will be submitted to the Hyperledger next year, so I'm guessing it is going to be on the Hyperledger therefore.
Indeed, but it's probably worth for the listeners explaining what that means. So Hyperledger is like a big bucket, right? So you've got this open source foundation, and in that bucket, you can drop a whole lot of code bases. It's like dropping different car engines into your car. You can pick the red one, the blue one, the green one. And right now, IBM built let's pick the blue one, and AxeCore has the green one. That green one isn't in the bucket yet, but actually they're already using it. So yeah, it will sit inside Hyperledger, but it doesn't yet. So when people say, are you using Hyperledger? They're typically asking me, are you using the blue one that IBM built? And actually, in this case, no, they're not. They're using something that might sit in the bucket that IBM built that IBM didn't build, if that makes sense.
So Simon, quick question on the nature of distributed ledger being more open source. Is the proprietary nature actually contributing to the high cost for this and the price tag from Axoni?
Possibly. I mean, I think there's a challenge always, right? Do you engineer something that's highly bespoke and solves a very specific complex problem? And can you open source that given how complex and bespoke it is? Like if you've got banks and you're integrating so deep into their systems, then can that really ever be open source? Well, bits of it could be, but actually how that integrates all the way, or some of the specifics that does, is very, very difficult. So the high cost at the moment is the fact that what's happening is you've got this one centralized system that everybody has to talk to, and then they're all trying to talk to each other and talk through that centralized system. Whereas in the future state, like getting access to that system would be faster, cheaper, and they could also talk to each other peer to peer. It's like kind of if we all had to send messages via Chris in order to talk to each other, but Chris is in Singapore, right? Whereas here on the Google Hangout, we can all talk to each other peer to peer. But if we all had to send messages via Chris, it could take forever because he might have sound problems, for example.
But I think you should in future send all your messages through me. That works for me.
I'm worried about your translating skills, Chris. The subtlety of your Exactly.
Je ne sais pas.
Whilst we're with you, Chris, there's a story here in the FT about banks risk missing the 29 ring-fence deadline. What is a ring-fence deadline?
Well, basically, there was a huge investigation into the issues within the banking sector after the global financial crisis, called the Vickers Report, after Sir Martin Vickers, who ran the commission investigation. And at the end of that, they concluded that the risk to the person on the high street of losing their access to a cash machine is caused by casino capitalism in the investment markets. So as a result, rather than saying that banks had to completely shut down investment banking, they said, you have to run your investment banking operations as a completely separate ring-fenced operation that will have no impact on your commercial and retail bank operations should there be issues in the future. And to do that, all the systems or the structure has to be separated, effectively making it a subsidiary holding company. So you have a retail commercial bank that's one part of the organization and completely separate with its own capital structure and management team, the investment operations. And that's a massive ask for the banks to create that structure. It's for the bigger banks, those with £25 billion worth of deposits or more. And what they actually have to do is by January 2019, separate themselves. And to do that, the Treasury has estimated it will cost them about £3 billion each to set this up, with annual running costs of £4 billion a year. And you can see why it's so difficult, because it takes a Royal Bank of Scotland, who couldn't even separate part of their own bank to sell it off as a division of Williams and Glyn. The same with Lloyds when they separated into TSB. TSB's operations run on Lloyds systems because it's too difficult to separate all the technology out. And Banco Santander is actually saying this is actually too much to ask for us because we're a Spanish bank. This is a British ring fencing rule. So we'll just separate our British retail operations and put all of the rest of the operations back into Spain so that we can deal with the Brexit issues as they come up. So it's pretty complicated. And at the end of the day, it doesn't solve the issue anyway, because most of the banks that imploded in the financial crisis were retail banks like Northern Rock and Bradford and Bingley that had no investment banking operations. So I kind of see the whole thing as a bit of a mess, to be honest, and I still don't think it's going to solve the issue that they're trying to address.
So, Chris,
any other thoughts here?
Yeah, I actually have a question. Chris, what do you think about the approach of just saying we'll set up a brand new, and here's the opportunity to be a truly digital bank, but set up brand new operations that are fundamentally separate from investment? Isn't that an opportunity for a bank to really jump into the digital space in the right way, building it from ground up instead of trying to re-engineer and reorganize their back system operations to account for ring fencing?
You would like to think so, Gayla, but that's a bit of a utopian vision when you have an existing, billions of deposits and millions of customers in the existing branch-based operations, and they're actually saying you've got to separate those branch-based operations from any of your investment bank activities or capital market activities, and that's really breaking up the existing structure. And none of the banks have taken that as an opportunity to reimagine the bank. They're just doing it as, we've got to. And how do we do it?
Do we think that deadline is going to be completely missed? Do we think it's going to just become arbitrary? What happens if all the banks just say, this is too hard, we can't do it, Brexit's happening, low interest rates, etc., etc.?
Well, the thing about regulators, and you see this all the time, and UK is no exception, but I was just asked to write something about the European landscape for banking outlook in 2017. And obviously you've got the systemically dangerous Deutsche Bank. How the hell could Deutsche Bank separate all its investment operations from its retail and commercial banking operations? But equally, you take a rule like the single supervisory mechanism in Europe that came into force in 1st of January 2016 that says no nation state in Europe can bail out their bank, and Italy just goes and bails out Montepaschi di Siena because they couldn't find an investor in it. You just ignore the rules. The rules don't matter. You try and follow them, and at the end of the day, if you don't, what's the punishment? I've never seen any bank punished.
Well, there were some pretty big fines for a little while. The big fines tended to happen though where somebody was breaking an existing rule, and typically they were around KYC. Whereas it's a little bit different when there's a new rule coming in. Those deadlines seem to slide to the right pretty consistently. But
deadlines drop. You've seen that with Payment Services Directive and SEPA. But even if you flout the rules in flagrante, so to speak, as we saw with UBS in the States with tax dodging and potential money laundering and fraud in HSBC, what you end up with is just how much can we fine these guys without the bank going bust? Oh, £8 billion, that will do. It's basically the system is set up to protect the system. Oh, sorry, I'm going off on one.
Well, to prevent the going off on one, let's ask Aidan to tell us about the next story. So, Aidan, the story here on Mashable, which is a fun word to say, about 56,000 petrol pumps in India stop accepting credit and debit cards. Apparently, the citizens are miffed.
So this is a continuing fallout from the demonetization in India. So Narendra Modi's decision to remove 501,000 rupee notes from circulation, and I'm fascinated by this personally. It's the biggest kind of financial services experiment I can remember in my lifetime. Probably the crash withstanding. Yeah. So what's happened is that there was a discount applied if you bought petrol using plastic cards. And that window, which was 50 days, finished on the 9th of January. So the bank said, great, and they levied a 1% transaction fee on top of card payments for petrol pumps. The union that runs those petrol pumps said, no, we can't afford that. Our margins are already razor thin, so we will not accept plastic card payments. So at a time when cash is running pretty low in India, as the new notes are still not out in circulation in force yet. We've got a situation where people can't buy fuel for their cars. Now, there has been a reprieve following some, I imagine, highly flammable talks. Sorry. And they've said that they will accept plastic cards until the 13th of January. ICICI Bank, one of the biggest banks in India, have actually said that they will drop the 1% charge as well. So it's going to be interesting to see how this one plays out, because it's fascinating the fact that you're starting to see this shift. And Leslie, I'd be very interested in your thoughts on this, but you're starting to see a shift of from cash to electronic means of payments. You're then starting to see the impact of those kind of merchant fees, which might be hidden in the past, but now they become so, such a challenge on razor thin margins. How is that huge behavior shift from a massively cash oriented society to a more digital society, let's say? I'm fascinated on how that plays out.
I think this is a really, really tricky one. I mean, the regulators have done something with really good intentions, but the human stories that are coming out are amazing. At the end of the day, people need petrol, and they're used to paying cash, and they're used to receiving cash, and suddenly there are charges and there is no cash, and there's all sorts of stuff going on. There's people dying. There's all sorts of implications that are coming through. It's going to be a really interesting year in India. I don't see the deadline being actually the 13th of January. I think things will change again. We really struggle with merchant payments in general in these emerging markets alternative payment schemes, because people are used to handing over cash, proximity payment, cash to cash, and it feels like cash is free. Obviously, if you work in the sector, you know this is not the truth. But on the ground, that's the way it feels. And it's not a solved problem. The whole business model around merchant payments, where the industry is used to cash, it's a really unsolved problem.
Yeah, I'm sorry too, but this is from a business perspective, it's a huge miscalculation on banks' part, right? And the card network's part, because to your point, India's a cash economy, and Modi's cash crunch, crisis has gotten people to try card payments, gotten them to try electronic payments. From a business perspective, you want to let that run for quite a while, right? And get people to see the convenience and the safety of paying electronically. The last thing, I would have done was, hey, let's try to make some money on this, right? It was just very tone deaf move.
Absolutely. And I think that there are new things afoot as well. I mean, there's new payments bank licenses that have been issued in India. There is the Paytms in the space that are coming in, taking a massive growth trajectory because of this, putting big full page adverts in the press. The awareness is changing massively around digital, and it's short-sighted of the banks to not recognize that there are challengers that are going to come and be able to play and play quite differently from their system.
Also, the government-backed, is it Aadhaar app, which is the app that they're trying to launch around payments?
Aadhaar is part of the KYC new national identity kind of systems. There's lots of tech being put in play in India over the last couple of years that will start to show some dividends in the next few years. They've got something called the India Stack, which looks a lot like some of our API-centric thinking. Aadhaar is an identity scheme, and there's also a national payments switch effectively to harmonise on payments between things. So the Visas and the MasterCards of the world are not going to have the same impact, I would say, in India.
Well, that's really interesting because Aadhaar is something that's been heavily pushed by both Infosys and Bill Gates. So there's a financial inclusion element to being able to do KYC. There was an interview on a new FT series podcast. The first one they did was interviews with the founders, and it was Bill Gates and the founder of Infosys talking about how Aadhaar is truly transformational for India, because having a national identity scheme linked to a fingerprint for 1 billion people solves a problem that no other market can solve. But then there's this approach that says, okay, now we've kind of got that in place, let's just rip cash out, which is kind of a little bit rapid.
I mean, the rationale for ripping the cash out was the fake banknotes, but did all the pieces of the puzzle come together, or was it working in a silo? I think there's an issue there that it was a bit quick, but they did it for a reason, and they meant well, but it wasn't completely thought through.
You can see the logic of getting rid of fake banknotes, about moving people towards electronic money, and all the challenges that come with moving to electronic money. But
they've got the same issues as in Kenya, maybe in a slightly different way. But I mean, the smartphone penetration isn't there yet. The telcos are only starting to set up payments banks and the like. We tried to launch M-Pesa in India in 2008, I think, and the regulations just made it really tricky. It is launched. It launched eventually, but it's quite a different beast to what it is in Kenya because of the regulations that are there. And people aren't ready. They weren't ready for this electronic money thing. They had to learn about it very quickly. But they don't have smartphones. 60% of the world are still not on the internet. It's a little bit different in India than in Kenya, but in the rural areas, people aren't on grid. And that means, how do you charge a smartphone when you get one? You have to pay to charge your smartphone. You have to take it to a shop. You may not be able to read. So are SMSs any use to you? Are smartphones any use to you? You've got to think about different user experiences. And are all these problems solved? Not in India, not yet. There's certainly really good strides happening, but it's not going to reach to the financial inclusion sector for sure.
That's
I was really surprised by the move of the Indian government towards getting rid of high denomination notes and what they're doing to go cashless. It's admirable, but the nation isn't ready for it. I mean, 95% of payments are made in cash. And as you just mentioned, most people don't have smartphones or even a phone. I can't remember the latest numbers I've seen, but it's something like 65% of Indians in rural areas do not have access to a telephone. So to expect them to suddenly be cashless, it seems stupid.
Yeah, and no wonder they're miffed per the headline. And speaking of headlines, let's move swiftly on to the next headline. Another one for Aidan here from Banking Technology. There's a humanoid Aira to assist customers in HDFC Bank branches. Aidan, what's this about?
Yeah, we stay in India, and this time a slightly more technical advance. HDFC have introduced in-branch assistant robots called Aira. This story caught my eye because, well, I always like to see people trying robotic things in branches to make them seem relevant. And I used to work with someone called Aira, and I'm wondering if they were a humanoid. It's a robot. It works in branches. It wanders around. I think it's a great PR move, but I'm not really sure of the value of it. It was built amusingly by a company called Asimov Robotics, which I don't know if it's just meant to be, but it reminded me that the laws of robotics, the 3 laws: a robot may not injure a human through inaction, allow a human to come to harm. So by that, it probably it's not allowed to sell bad products. A robot must obey orders given to it by human beings, except where such orders would conflict with the first law. So that means it wouldn't work for unethical bankers. So yeah, I think it could work, but I've not seen these schemes roll out well. City Union Bank in India earlier this year launched a robot called Lakshmi, which was backed by IBM's Watson. And in a dim and distant past, Santander had robots in their innovation center, and Bradesco in Brazil had a robot called Link 237. So these things have been tried in the past, but I'm not sure that automating the humans in branches is the thing that is the problem with branches. But they are just, these stories are catnip to me, because they're like, who signed off these business cases to put a robot?
It's crazy. Like the appetite for senior bankers to do gimmicky things in branches is seemingly endless, and yet the business case benefit to it is always pretty much non-existent. So you got to question, like, we know you don't know what to do with your branches other than close them. So, like, do something that's not stupid and gimmicky. Do something that's actually really going to help customers. And I think a lot of that is, I point to yes, they're my former employer, but Barclays Digital Eagles, I think, is a really good program of work where you've got humans helping other humans. You've got people helping people be digitally engaged and kind of really understand this new technology, especially vulnerable and the elderly in communities who have gone to the bank branch for all of their lives, and now suddenly they walk into the branch and all the humans do is push them to some kiosk. To actually push them to the kiosk, but very gently show them how to do it, and also show them how to use Skype, that is something that you can really do, and it turns branches from a liability back into an asset, and really something that builds your brand. I think that's something that I'm surprised I haven't seen more people just rip off, because it seems to be really working for them. I don't know if you guys had thoughts on that.
Well, I think it goes back to what we were just saying about India, which is there's this big assumption that everybody wants to use digital and mobile apps and mobile wallets, and that they trust the technology. And yet, if you go into the average bank branch, it's not like that at all. I mean, the average bank branch customer might be someone who is earning £20,000 to £30,000 a year in a semi-skilled job, who actually isn't that comfortable with dealing with machines, but wants to actually get advice from humans. And it kind of irritates me a little bit when we make this assumption that everyone is, white collar professional, millennial, earning 75,000 plus a year. Most people aren't like that at all. And exactly to your point, Simon, that if you provide a human interface that's supportive and encouraging and coaxing, then that's what's going to work far better than trying to get a robot to do it.
But actually, there is something in this robotization, possibly not in branches, maybe not, but there's an example in Tanzania where rural farmers were given access to effectively what is a chatbot. It was an SMS-based chatbot where they could ask free-form questions, and the machine learning was able to give them back answers in a guided learning thing. It was fairly static. The impact on what happened was actually, I think, quite phenomenal. The guided learning was around how to save and how to use the digital savings product attached to M-Pesa. And they saved 5 times more money. They asked for bigger loans, and they paid back more money. That impact to that product and the awareness and the training and all that kind of stuff, to get that at scale, digital services like robots that can talk in free language and have the farmer actually think, who is Arifu? Who is this person behind it? When you read the blog, it's like, it's amazing. Mm-hmm. And I think there's a lot we will be able to do with that kind of human kind of interaction.
So the ability for software to understand language and to respond to you is becoming truly
Yes.
phenomenal. And actually, it was Richard Brown on one of our previous episodes, the CTO of R3, who said, kind of imagine those emails you get where you can't reply to them. If instead of having a no reply, there was actually a chatbot on the other side of it, like those sorts of interactions that currently there's no human on the other side of, but could really use it and could really benefit. That I totally get from a customer service standpoint or from an education standpoint. But sticking a physical robot in a branch.
Yes. No, I hadn't even seen the picture when I first read the article. Wow. Yes.
It's also the reason why in the 2017 predictions, nearly all of them have got chatbots as the, this is the year of the chatbot, because that definitely does make sense where you are having that natural language sort of interaction with a device. But again, when you actually go into a physical context, you want to have a human there.
Absolutely. And
but I think this speaks back to, we've had a couple of conversations around this, Simon, earlier in an earlier podcast too. It comes back to how do you translate the human experience that customer adoption and customer behavior responds to? And tech for tech's sake is not the solution. And I think that's part of the challenge and the hype of the industry, is that there is an aspect of tech for tech. But if you really focus on what has most utility for an individual at a very, very personal level, we have to go back to basic fundamental needs. It's the Maslow hierarchy of finance. And are you getting that guided customer experience? Are you getting that bespoke advice? Are you getting what feels incredibly personal? Money's personal. Are you still getting that personal element in the interaction with your financial service provider? And if it comes through a gadget that looks like it's out of the Jetsons, is that cool enough to replace the human touch? And that's,
I think there is something. There's definitely something about mid-level executives enjoying the cool factor of a chatbot that's not helpful. And they may even use the word customer an awful lot. Like every third word they use is customer and customer experience, but actually really being painful and like just grueling with customer interviews and getting to the root of the customer problem and actually trying to kind of understand what job is this person trying to do. Like, are they trying to run their farm better? Are they trying to save? What problems do they face in trying to do that? And getting into the psyche of your customer is something that I think a lot of people that pay lip service, and I'm pretty sure they mean well, but they pay lip service to customer problems and being customer centric. They say we want to be customer centric in that we're going to do a research once, but actually sitting with them day in, day out and trying to understand their job to be done, inviting them into your office, all of these things that, Jason talks about quite a bit, I think become really, really, really crucial. And then you avoid the tech for tech's sake. But anyway, being master of ceremonies, once again, I've got to move us on to the next story. And the next story is a little bit on theme for the roundtable that we'll have coming up in just a little while. But I like this one in the Financial Tribune here. Iran's first open banking API has been launched. Now, it seems there's a meme catching on. Everybody wants an open API these days, but actually, this is launched. This is real. There are 12 bits of API functionality that you can apparently go and use, including making payments or transacting without technical knowledge, and apparently it's in a totally safe environment. So I think it's interesting that we're seeing this coming from Iran, a market not typically known for its banking innovation. But what I really wanted to talk about amongst this group is, we're seeing stuff where regulation is pushing for APIs here in Europe, and that seems to have kicked off a conversation around the rest of the world. Do we think that actually regulation is going to drive this, or is it just sparked a conversation and we're actually going to see more interesting things coming from other countries? I don't know if David, you had thoughts, or Leslie?
Yeah, so it's I think it's going to be both. And I have the same fascination that you do in kind of watching this unfold. When you look at it historically, banks have had very large, very deep, very wide moats around their businesses. There's so much regulation. They're so protected that, they haven't, in many ways, they haven't had to compete with outsiders at all. It's a very protected business. And therefore, they haven't done a lot of these things. They're very slow, late to digital, very late to APIs. And now you see regulators essentially shoving them in the back to get going with the program, right? And what's been really interesting is watching regulators from different countries where the regulators themselves recognize that the competitiveness of the financial services market in their country depends on this. Right. So, when the EU came out with, PSD2, UK regulators, Open Bank Working Group, and CMA basically said, yeah, right, okay. London is, premier financial capital of the world. We're going to do, effectively the same thing, but we're going to do it slightly broader and slightly faster, right? And you see some of the same things happening in Asia, where Singapore has basically said, hey, we're want to be the financial center of Asia, so we're going to, start pushing and talking to the banks. And you see Australian regulators doing some of the same things as well. So it sets up this really interesting dynamic where, actually the movement gets started by regulators wanting to compete with other countries in a digital way and trying to push their financial markets, their financial players, their banks to do that.
A quick question for you, David, though, it comes down to the market structure for Iran. It's a closed banking system for all intents and purposes. It's been embargoed by a number of different nations. There's such stringent oversight into any transactions that are done in Iran or with Iranian banks, especially from an AML KYC perspective. This more closed system encourage them to be more open and innovative and allow for that kind of, let's open our black box and let our businesses plug into them. Let's actually let other third parties plug into our systems. Is it maybe coming out of Iran because it's such a closed and protected system that it allows or it forces it to do that?
Yeah, I have no idea. That is a super interesting idea. It may just be a point where, hey, we don't have a lot to lose, so let's just go for it.
I've got some idea because I've been to Tehran several times, and basically,
tell us.
There is a quite innovative group of banks there that work cohesively together. And in some ways, it's similar to Turkey in that Turkey's a neighbor, and in both markets, you see the central payments provider, the ACH, encouraging collaboration on innovation. And I can quite easily imagine that Iran wants to be seen as a fast-paced, innovative economy, having come out of being under the sanctions as a Jimmadad before, into a way in which they can show leadership. So this is maybe the start of moving in that direction.
Pretty interesting, Chris. I'm going to leave this one here because we've got to take a break for our sponsor. But when we come back, we'll be talking all about APIs with our guys.
Let's be honest, most digital banking experiences just aren't that amazing. Learn how more than 180 banks worldwide, including Barclays, Deutsche Bank, and BBVA, innovate faster with Strands as their trusted fintech partner. To find out more, visit strands.com today.
Critical mass. That's what turns the smallest ventures into life-changing forces. Reach critical mass by joining Temenos Open Marketplace for FinTechs, opening up access to 2,000 of the world's largest financial institutions. Don't just take our word for it. Temenos Marketplace has just won Reader's Choice Best Emerging Innovative Technology Product and Service at the 2016 Banking Technology Awards. Join Temenos now. We make the money go round.
So thank you very much to our sponsors, our fine sponsors. We are back here with Leslie Ann Vaughan. Leslie, could you just give us a little bit more background in your experience in APIs, what you've done in this subject?
I've sat both sides of this equation. So on the M-Pesa side, I have been the one trying to figure out what APIs we should be putting on the platform. And to be honest, we're going back here to 2005. It was more of an integration than an open API play. It was in a telco environment. It's more SOAP than REST, all those kind of things. But about 3 years ago, I spent a year at a startup. And before that, I was 3 years at a different startup. And I was in Kenya trying to figure out how to connect to mobile money companies, in Ghana trying to figure out how to connect to mobile money companies. So I've felt the pain on the developer side as well. So I kind of feel like I can kind of be devil's advocate for either side, if you like.
The devil on both shoulders.
Absolutely.
So David, our VP of Vertical Solutions at Apigee, a little bit more about what it is you do at Apigee, David.
Yeah, the company formerly known as Apigee, now known as Google.
Yes, that's a good point.
But yeah, so I actually joined Apigee before it was Apigee in 2007. So I spent almost not quite a decade working on APIs. spent quite a few years just helping getting the commercial efforts of the company off the ground. Some of our largest customers with telcos. So I spent a couple of years trying to help telcos understand APIs and get their API programs started, which actually led me to live in London for a year, working with the European telcos and API programs. And now I'm back in the States. I'm back in California, working with financial services companies because we've launched a banking accelerator to help banks adopt APIs faster, and some new security products that I'm also leading the go-to-market for.
Very cool. And we've been joined by Aubrey Hawes, the Senior Director of Product Marketing at Oracle. Aubrey, nice to have you with us. What is it you do?
So I am responsible for product marketing for the digital banking solutions that Oracle produces. And in that space, it gets back to our use and leverage of APIs and how we're actually not only creating vertical APIs in the banking space, but how do we make access and APIs available to our data services that we provide, as well as kind of the overall governance of those. And from a background perspective, I've been doing that for a while. Prior to that was a software developer, actually writing, creating, and actually using the APIs before I started to kind of go to the dark side and just talk about them.
Tremendously cool. I've been hearing the word tremendous a lot lately. I don't know where I might have picked that up from. It's just, it's become a meme and I can't get it out of my system. Alrighty, guys, talk to me a little bit. I'm going to put the jar of candy in the middle of the table and I'm going to ask Leslie, David, and Aubrey to fight over this jar of candy. Does somebody want to describe what an API is? Because we throw this term around and I find a lot of people want to explain it to me who've been in banking for 30 years, but everybody seems to have a different idea. And I want to get a really good feel for what an open API is and what a developer-friendly API is more specifically. Who wants to take a crack at that one?
I can take a stab at the layman's answer for those listeners who are not very technical. In very simple terms, an API is how one software program or piece of software talks to another software program or piece of software. If you think about your house, and we're getting to more of an IT type view, right? When you think about your house, there's wires running through the walls that carry electricity. Much like you can imagine networks that carry data. And if your significant other, your wife or husband, wants to put a lamp in a certain place, you just walk over the wall and there's a plug and you just plug it in. You don't have to call an electrician. You don't have to have a big special wiring project or anything to effectively wire the lamp into the wiring inside the wall. You just plug it in. That plug, that receptacle, is essentially like an API, right? Makes it very easy to plug the lamp in, to move it around the room. Don't really need to call an electrician in, have a big expensive project to do so. Yeah, in IT, in the past, it's always been big, expensive projects to wire new things in, right? Those are big integration projects, expensive, take time, have to call in the specialists, and what APIs have done, specifically RESTful web-based APIs, with the associated tools around them, have made it very easy to plug in different software programs to tie in different things. And one of the former programmers give a more technical explanation, but in very simple layman's terms, that's the way folks should think about it.
I like that a lot, David, and I'm going to ask Leslie Ann to play metaphor tennis with you here. Like, do you have one?
So we have this metaphor that we use. I work with CGAP, Consultative Group for Assisting the Poor, and we work in this API space, trying to explain it to execs quite a bit. And we use this analogy where an API can be thought of as a menu at a restaurant. So you're placing an order at a restaurant from the menu, which is like calling an API, and the food that comes to the table is the system's response to that API call. And it's almost you're guaranteed. It's like a contract. You ask for eggs on toast, and eggs on toast should come out.
Unless you're in a crazy upside down world in which you get something you didn't want.
And you want it within a certain time frame, right? And all those kind of things. You're effectively putting the contract together. But it's a menu, it's public. You can read it, you know what to expect.
Very cool. I like that one. Aubrey, any more? Anything to add?
Well, so I'll maybe give a financial services example. So I like to think of, if you go back and we're just out of the shopping season where everyone, it looks like in a lot of markets, bought everything online, and so many people can go back and just access PayPal to do their checkout. I mean, effectively, PayPal is offering up an API to any one of those e-commerce players to allow that to go back and facilitate the checkout process quite simply. And that's probably the last bit of coding I've done, is actually embedding that into some philanthropic kind of work that I've done. It's easy. You don't have to worry about how it works. I don't have to worry about how you capture those details. It's a service, an API that I'm just plugging in and taking advantage of. So it really starts to enable almost like these citizen developers. So I don't have to build everything. I can go back and pull things that already exist.
That's the key. What you're saying there about it being easy and about citizen developers, that's where the difference is between some of the more intricate stuff we've done in the past with SOAP and the new, more modern REST-based APIs are very much focused at citizen developers and how do we make it actually as simple as possible.
So there's this thing about simplification. SOAP and REST sounds like a really good sort of Sunday evening preparing for a Monday. But like, what is the difference here? Like, is this simplicity thing the kind of key? Is this why we're talking about open APIs now?
So some of the developers that I'm coming across, they're not Cambridge educated, they're not doing computer science degrees. They are coming along and doing some web programming. They're familiar with URLs, they're familiar with the concepts, and I think that's why REST is trendy at the moment and it's sitting quite well. It's not that there's anything wrong with SOAP, it's just that's where your citizen developers have a comfort zone.
Because if you make it super simple, then you could make it so that anybody who can code HTML can do some basic stuff with an API, but doing powerful things is a lot more. David, did you want to add to that?
Yeah, but it's more than just SOAP and REST, right? It's the whole model and philosophy behind it, and the programming languages that are used in the developer community. I mean, there's a lot to unpack. There's a lot around it, right? I mean, certainly when you just look at the technologies, RESTful-based services, RESTful APIs. Yes, they're easier than SOAP to understand and learn. But along with that, internet companies, or what we think of as digital natives, have also built self-service tooling and onboarding for those things, right? To make it really easy. There's description languages to make it super simple. They've built kind of try and buy, or free to start, free to develop models on top of them. So there's a lot more than just picking a shape, a technology for your API, right? And even the data that's returned, right? Yeah, absolutely. And I was just saying, the data that's returned is now modern programming as well, right? Where it's returning JSON instead of big heavy XML. In the world of mobile, that's super important. So there's a confluence of factors.
Is there something about the API itself is just the tip of the iceberg, and actually everything you put around that is where the skill is, right? So anybody could go make a RESTful API if they've bathed themselves in SOAP before, but there's
build it and they will come, right?
Yeah, absolutely.
That's the key, right? To open APIs and have a business model that will actually get some traction, you've got to do a whole ton more in that awareness space, in the education space, in the meeting people where they are and pricing it in a way that actually you're not turning them off. Developers are going to try things. They're going to want something for nothing. How do you get them hooked in? That's the key if you want to monetize in this and have developers pay for your services.
I'm all for more Wayne's World references, by the way. But speaking of getting developers hooked in, how are we getting banks hooked in? And why, Gellert, talk to me a little bit about why we think banks are getting interested in this now. Is there a psychology thing here? Is this just the emperor's new clothes, or are there real opportunities here?
Well, I am of the perspective that there's opportunity, and it comes down to what I call unconscious banking or unconscious experience, where one doesn't have to think about how am I going to pay at the point of sale, how am I going to take the steps to make this transaction, but instead be in an app. I mean, I was on eBay just earlier today, and I love the fact that the API for PayPal just allows me to click and pay. I don't have to think about logging onto something else and verifying my information, double checking the credit card. it becomes instant gratification. And I think that's the change in the psychology of acquisition. And it's also the change in the psychology of money movement. So API allows that in the sense that third-party providers or the payment services directive specifically, where you've got a payment service provider versus an account service provider, it allows that conversation to happen. The customer doesn't have to know about it. They simply experience the end activity as being unconscious. It's just one more click. It's a single click. It's not 7. And I think we're moving towards that, especially with Amazon Go as an example. Of that kind of experience. So does API banking actually mean it's less physical steps and less physical activity for a customer to access and move their money and acquire? And how does the bank provide that? So I do think there's a business model in the sense that you're looking at a customer satisfaction and experience angle. It's also kind of bringing every bit of information that anybody would need to make a transaction in a single spot. And there are these easy plugins that allow people who do or create a solution that makes it so super easy to actually give that to the customer via a traditional banking channel. And I do think there is that massive risk of moving the banks into the dumb pipe territory, becoming the telco. But there's an advantage for banks to actually being that white label service where they become the stop and shop for everything that a customer needs to make a transaction, make a purchase, move money, and they still remain that institution of trust. But now we've got all the tech that allows those customers to unconsciously experience that trusted money movement. I mean, that's unconscious banking is what I call it. But
yeah, I like it. I've never consciously, unconsciously banked before, but I think that's quite an interesting idea. And you talked a little bit there about, you mentioned PSD2, and you mentioned really, I think, like what's the thing that prevents banks from becoming telcos and just disintermediated and away from their customers. And I think there's something really in that, because PSD2, as we know, is the regulation coming from Europe. And then also we've got the Competition Markets Authority in the UK that has sparked a lot of interest in Europe, but also around the world in this concept of open banking and open APIs. And there are plenty of banks in the US and around the world embracing these open APIs. But talk to me about the business case here. Are banks just turkeys voting for Thanksgiving or Christmas, depending where you are in the world?
Yeah, I actually, I have opinions. They're ill-informed opinions, but I think the people on the front line. Aubrey, as you're talking to banks about doing this, and especially in the States where there isn't a regulatory incentive to do it, there's only a market incentive. The business case in my mind is actually remaining relevant, and it's not turning into a dumb pipe. And even though you have to open up your architecture to allow third parties in, the incentive is that you still remain in the end customer's eyes, the institution that provides that. And when you still remain the trusted source of money protection, movement, et cetera. And the business case is that you're really actually becoming the only source or the first place that a customer would go to, irrespective of them being on the corporate investment or consumer side. And it matters about market relevancy. It doesn't necessarily matter, that you've opened up your systems. It's that you still remain perceived as that institution. And I also think it makes a big difference in terms of the end customer experience. If you can give them the service that they want. Banking is about product and service, primarily service though. And if you can actually enable that service experience, that's the business case. It is improving the service itself. Instead of asking, again, the customer to do 25 steps to make one transaction, it's a one-click button, and that service has increased, and that quality of service actually exists. And it's reducing complexity for the end consumer.
Well, correct. And I would actually, so the interesting thought is, I think kind of beyond just kind of, as we talked a little about, whether it's the Amazon Go or PayPal, how do I go back and add kind of this short-term point of purchase financing or leasing as a part of that checkout, to go back and enable those merchants to go back and facilitate that customer checking out with more goods. So, and I think you get back, your point is, they're not dumb pipes when the first movers that open up these APIs and go back and expose them through these channels start to give their customers more choice for ways to go back and activate that. We're seeing the same thing on the corporate side, which says, the banks are starting to figure out how do they open up to the corporates to make it easier for them to go back and shorten that whole onboarding cycle. Well, the way you do that is via API, so you can kind of get out of this kind of passing back and forth all these documents and allow those to be more an online API sort of call, that you will be able to do several things that will benefit the corporates because it'll be a much shorter time to onboard. For the banks, it actually is a lot shorter time to revenue because they're able to actually get them onboarded and start to deliver those services will actually impact their ability to go back and generate revenue.
Well, and I think that speaks to standardizing experiences, right? It's a standardization of process that allows you to scale it. And if you can pre-populate that by making a single call and you've reduced the amount of paperwork, it's a green effort, but it's a time effort. It does shorten the sales cycle for both sides. And that, I mean, that's crucial. You want to talk about revenue drivers, shorten my sales cycle. I will pay you immediately. Isn't that the whole point? I think but I mean, it also does facilitate a cross-sell and upsell opportunity. When you do think about the point of sale lending, I mean, that cracks open alt lending in an entirely different way. And you can still make a cut on that transaction, even if it's an alt lender, if you're a bank providing that particular service as a partnership. I mean, it does open up different channels for revenue. And I think that's where the most incentive is being really creative about what else can we do the value add term drives me bananas, but where do we actually provide value in that experience? Because it is a service experience. If we can do that using somebody else's tech that makes it super easy, the customers are going to pay for that end experience and they're going to pay for the value of that service. I want to know if I can buy something immediately. I want to know that I don't have to fill out 25 pages of paperwork. I want to be able to say I get my line of credit as a small business really quickly and that I go through all my KYC really quickly. I will pay for that experience and that ease. And I think that's what API banking actually does. It's the ease that we pay for. And someone else is taking care of the hard crunch.
Yeah, I think we should go back to the original question, right? I like to simplify this because we've ripped across a whole lot of topics in the last couple of minutes. Fundamentally, most bankers I talk to will understand that consumers are moving to mobile. All of the connected mobile apps that you use on your phone talk via APIs to get their data. So when you check the weather, there's an API call from the weather app on your phone to some system to get the weather data, right? Searching for a restaurant. Most of those things, for any of the really good app experiences, all those native apps, they all talk over APIs. So, bankers should be very interested in APIs because it enables digital experience, right? And it doesn't matter whether it's the consumer retail digital experience. It could be the in-branch digital experience. Some of the banks that we're working with, it's also the private banker digital experience. So your own employees having great digital experiences that can pull information from different systems so that when they're sitting in front of a high net worth client in the branch and they've got their iPad app, we've got some retailers that do this. They call it clienteling. You can pull all that information in, know everything about that customer and sell to them and help them better, right? So there's kind of one level of activity from a bank's perspective that says, look, the world is moving digital, the world is moving mobile. We need to get much better at APIs, and in fact, many banks might already be using some APIs for their mobile experience. That is just the start. That is just the start. And there's a whole nother level to APIs that you've seen the internet natives, digital natives been using for years, which is looking at APIs as a distribution method. Essentially a bank could almost look at the APIs, as another channel, right? They've got branches, they've got ATMs, they've got websites, they are playing around with trying to get mobile banking correctly. And you can say, and I also have APIs. And in fact, the APIs can really underpin all the rest of
I was going to say, David, I was going to take real issue with it being just another channel, because I think it's much more powerful than that. It's kind of the thing underneath all of the channels, and also like you can kind of give access to it. I mean, at 11FS, we've done work with a number of clients explaining APIs, and I think the channel thing can be kind of confusing. Maybe it's a nice gateway drug to understanding APIs, and I guess for some people it is. But I find it's underneath the channel, and actually you let somebody else build their own channel. That's kind of the point. You let any developer build their own channel. You just provide them with the Lego bricks. I mean, Leslie, why should banks care about APIs? And we hear a lot about security. Why do you think that is?
I think we have two crutches we always fall back on. Is security an issue? Is consumer protection an issue? It's easy to go to those defaults as we can't think about this till we figured that out. Mm-hmm. So it's always the default answer, and that, to be honest, I've been guilty of it too. Mm-hmm. I have sat in Vodafone Group listening to my Safaricom team tell me we must show the name of the customer before we actually do the transaction because but I'm going but consumer protection, you can't do that. What about all these things? And they convinced me, and they've done it. And actually, there's other ways to control things. You use your data, you get a bit more clever, but actually the benefits outweighed the negatives there around that security, potential data protection flaw, and all the rest of it. And sometimes we do need to listen to our end users and go, well, yes, it may be less secure, but what are the risks? And tackle it piecemeal by piecemeal. It's a hard problem though, because once there's been a breach, you are going to then start to batten down the hatches and get away. So it's a hard puzzle, but we have to get to a place where we can experiment to actually figure out. If we live in a cemented over hole, we will learn nothing. We have to be aware of our issue, our potential security flaws or our privacy issues, and tackle them head on and learn things, lean in, if you like.
Leslie, so is security just a straw man argument to avoid the conversation of maybe more complex API structure within an organization, or is in the industry as a whole? Is it just an excuse to delay?
I certainly, well, I've been the police man. And went absolutely not. And then they find workarounds, right? And they do it anyway. And then you realize, without me doing it properly at the back end, they've figured out a way to do it with a different database and kind of hook things in front and all the rest of it. They've done their own experiments and they've prototyped in their own way. And it's actually shown me, do you know what? If there are workarounds, if there are ways to screen scrape, if there are ways to do this, that, and the other, then why not put a proper API in place and do proper experimentation with proper consent mechanisms? So I've gone on that journey. I think it's a journey that culturally it's quite hard, I'm sure, for banks to do. I've worked with the corporates, but I've not worked inside a bank trying to tackle these challenges. I imagine it's quite cultural.
Yeah, sorry. I actually think it's just fear of the unknown, right? APIs have been out for more than a decade. One of the top 3 reasons that companies buy Apogee technology is for security. A lot of the technical things have been solved, right? They're absolutely positively solvable problems, and incredibly large organizations like Google, Amazon, and others have been running entire businesses on APIs for a very long time. So I think the security thing's a red herring. There's much more around not understanding the power of APIs, and we haven't even talked about platform business models yet. That probably leads people to have that pause and say, "Hey, well, wait a minute. I'm not sure I understand this. Therefore, I'm not going to do it."
Yeah, and I would, David, just to piggyback on what you said, I think you're absolutely right. I think there's been huge technology companies in California that are just running businesses and killing it with APIs. And I think that this is where the banks really need to, I guess just not the banks, but I think there's other industries that need to wake up and look at that. I think one of the things that's encouraging that I saw that we put here in our outline was something that I saw from earlier this week, where we had the new CEO of Wells Fargo talking about the number one digital initiative for the bank is all around APIs and the ability to go back and open up APIs. And I think part of what has to happen is that the top leadership levels of these banks need to really start to understand and get it. And I think some of them are starting to, because I think that will go back and help shape the culture inside of these organizations, because I think so many people in the middle of these organizations, I love the comment earlier, someone says, they're customer centric, and they have to say the customer word every 10 times. But does that really mean they believe it? I think these executives need to really see where financial services are going, and the ability to go back and open this up and allows them to go back and get better portability of these APIs, not only to support the channels they deliver today, but also all these other new channels. And I think you're absolutely right. David's right with Apigee and Google. Oracle's in the same space. They have products to go back and solve those technology challenges around how do you secure them, how do you manage the access. But it's getting that management buy-in that says this is where we have to go and we have to do it.
So, and that's quite a mindset shift, right? That's quite a mindset shift from a current business, which is very B2C end user, to a platform business. And there was an article recently. Jeff Bezos had an idea, and 6 days later it was implemented. That's only possible because they're an API first company with a platform business. And our current banks and my mobile money providers, DFS providers, they're not platform businesses, and they don't have the staff and the mentality and the culture yet. And there's quite a game changing needed to be done to get there.
Yeah,
but you're right. It's top down.
You could almost think of it as 3 levels, right? So we talked about digital experience, right? And the fact that most digital experiences these days and mobile apps are all built on APIs. We talked about APIs as a distribution channel, right, for your services, and then you just brought up kind of the third level, which frankly is really, really dangerous for companies, which is platform-based business models. Platform-based business models, especially today, built on APIs, are deadly, because usually in a specific market vertical or a segment, there's 1 or 2 that win. And we've seen this just as a we've seen this in cloud, right? So to your point, Bezos put out the edict, like it was 2001 or 2002, that said, hey, everything's going to be built on APIs. All of AWS, what all a cloud is compute, storage, and networking, and all those services built on a set of APIs, right? It's programmable data center. And you're seeing Amazon run away with that market. Microsoft and Google, probably like a second and a third. And really, that is it. Over time, it's going to coalesce. There's like one mapping provider and then a couple others that are going to make it. And you see this in vertical after vertical after vertical. I don't expect banking to be any different. When somebody does figure out what the banking platform is, they will own it. There'll be one winner and a couple, like a second and a third place, and that's it.
David, I think that's so key. I think that we've talked for a long time about who's going to be the Amazon of banking, but actually that headline behind that, what we actually mean is who's going to be the platform bank. And I don't know that anybody's grasped that, but it seems that, I don't know that anybody is that, but it seems like, as Aubrey pointed out, Wells Fargo and others are starting to get that. And at 11FS, we've been talking to clients more and more, and it seems like people are starting to get it. So if you're in a bank and you're just talking about how am I going to meet PSD2 or how am I going to meet regulation, you're kind of missing the opportunity to become the platform bank. But the good news is we have 3 experts here with us who you can reach out to and find out more from. So Leslie Ann, if people want to know how to become a platform business, how do they get in touch with you?
My name is so unique, you'll find me in Google, LinkedIn, all the rest of it. It's the easiest way to find me.
Or what about you, David?
Yeah, apigee.com or David at Apigee. I'm also on Twitter.
Fantastic. And Aubrey?
Yeah, so Aubrey Hawes, my name's pretty unique as well, but Aubrey Hawes at oracle.com or oracle.com/digital banking.
Well, listen, guys, this has been an amazing show. Thank you so much for joining us. And I want to thank Gela and Aidan once again for joining us. Chris did already have to disappear. Gela, Aidan, thank you.
Thank you.
We will have to have you guys back on to talk just about the platform business piece, because that is such an interesting subject in and of itself. When we've done workshops on that subject alone for 2 days at 11FS. But all that's left for me to do is thank everyone for listening. Remember, if you like what you heard, subscribe to our podcast. We're available now on SoundCloud, iTunes, and every other platform you can think of. Review us on all of those platforms. We love those reviews. That's all for now. Thank you.